Hey listeners, it's Paul Andriola here. Why not join our community at Small Cap Discoveries, where we offer our members direct access to some of the best microcap investment opportunities available. Our members are getting access to premium microcap financings, research reports, and direct access to management. Sign up today at www.smallcapdiscoveries.com.
Hi, everyone. Welcome to the Small Cap Discoveries conference call. Today on our call, we have the CEO, Steve Levely. He's back from Ackroo to give us an update. Ackroo trades on the TSX Venture Exchange under the symbol AKR, and it also trades on the OTC under AKRFF. Company is currently trading at 7.5 cents with roughly 121 million shares outstanding, or about a $9 million market cap. I'd now like to hand it over to Paul Andriola.
Thanks a lot, Trevor. Great to have Steve back. Steve, it's been a little while since we last spoke. Always good to get sort of refreshed with what's new and exciting.
I appreciate the invite back, Paul. It's been a good 9 months or so since I've seen you guys, or almost a year even.
It has, yeah. So I'm sure lots has happened since then.
Yeah.
So I'm going to turn it over to you. You got a pitch deck. I'm going to let you have at it, and then we'll follow up with some questions.
Sounds good. Yeah, it's been an interesting year for sure for the business, never mind just personally, but business-wise. So there's a number of updates to run through. So I'll get moving. I'll address both people that are new to the business, but also the current people. The name Ackroo, it goes back to accruing companies and accruing offerings is what we're up to here. We're a consolidator by trade, right? So we're in the merchant marketing ecosystem, gift, loyalty, point of sale, and so in doing so, our main growth model is through acquisition. We've been an acquisition first company for quite some time, where we're not just acquiring offerings, but actually acquiring companies. And we've gotten pretty good at it now. We're at our 12th acquisition to date, but we continue to kind of go down that path of being a consolidator or an aggregator in the industry. And that is kind of the premise of what we do here. And in doing so, our mission was to be a technology company, though, not a services company. So yes, we're an aggregator where we buy companies, we integrate them into our operations, but we're doing that with leading with technology. And everything we do as a SaaS business is a technology first company, taking those industries and those businesses and simplifying what they're doing, and then focusing across 3 solution types. Our core business, which is our marketing business, which is loyalty, gift card, and promotions. We've expanded into a payments business over the years. Early days, we were a partner to payments, and we learned really quickly, well, why don't we start selling it ourselves? So we're actually an ISO or a reseller of both First Data and Global Payments. So we can go to market selling devices like Clover and sell our gift card loyalty app right on top of it. So we kind of have a full service offering there. And then we also decided to get into the point of sale industry as well, going after some niche point of sales, because from the industry standpoint, you've got a point of sale system that runs the operations. You've got payments, which takes the transaction. And then you have marketing solutions like gift and loyalty that kind of tie together. These are the 3 worlds that kind of come together and collide. So we're going to market selling all 3 of these solutions to the marketplace. We kind of took an approach where consolidation first, where again, we're going to take up, we look at the industry and how fragmented it is. We want to consolidate the industry down as best we could. There's a better together model that we believe exists for us. We then made sure that from a technology perspective, we were not going to be a services company. We wanted to be a tech company. So what does that mean? Well, it means building lots of self-serve technology. How do we make the platform much more self-serve than full serve? And in doing so, all the technology decisions are around that. And then last is that because it is so fragmented, integration is a big part of what we do. How do we integrate our products to each other? How do we integrate them to other people in the ecosystem? So we spend a lot of mental energy on consolidation strategy, innovation of technology strategy, and integration strategy as well. And we've been doing it across 4 verticals. Petroleum, so think gas station convenience stores, hospitality, think quick service table service restaurants, automotive dealerships, and retail, which is all things retail, so think specialty retail and what have you. We have multiple solution sets now. So obviously a gift card offering, a loyalty offering. We've gone further into marketing. So think of communications tools like email marketing and text and push notification stuff. We're into the data world now. So a big part of the push in our industry is it's data, ROI data, comparative data. I mentioned earlier that we stepped into payment processing. So we are really like a payment broker. So you can get your rates through us for debit and credit. And then obviously we have a couple point of sale niche solutions that we sell today, but in the future we may resell as well. Our revenue story has been consistently growing since the founding of the business. There's about a 28% CAGR since founding. We've had kind of 2 flat years. The year I took over the business, which was in 2014, we had a flat year that year as we kind of went to reposition the business from an organic growth business to an acquisition first growth business. And then in 2021 through COVID, we had another flat year of the business as we kind of started to map our way through the drag of COVID. 2020 didn't hurt us. We really felt in 2021 from an attrition standpoint and really just stabilizing our business. But we got growth back on a good footing last year, closed the deal on literally like the last day of the year. And so when most of your growth is acquisition based, the last day of the year, we closed our latest acquisition. So we'll see much more substantial growth this year. From an earnings perspective, we've had that steady climb from lots of losses early days. We crossed over the chasm in 2018 into profitability and we saw a climb. But once again, that 2021 year, I think we made a number of strategic decisions that helped and also hurt us. One of them is we put a lot of energy and money into organic growth. And we put a lot of money into sales and marketing and more into engineering, but it didn't pay off. It didn't pay off, that investment, in the middle of also seeing a lot of attrition to our business. So we had this big earnings drop that year. So that reinvestment into the organic business didn't pay off fast for us. So we pivoted back. Last year, we put a much bigger focus on getting the cost down in the business, paying off debts and what have you, and got the earnings right back up again. Earnings get released at the end of April formally. You can sort of see our year to date, we've been guiding around the 20% EBITDA range as a business. And so we've got that back in check because we pulled back some of that spending and we saw similar organic growth with a fraction of the spend that we were doing. So the organic investment that was made didn't pay off as handsomely as we thought in 2021. So we reverted back afterwards. But there is an organic business at Ackroo, even though the main story is acquisition based, right? We buy businesses, that break even or even lose a few dollars and they come into our world and within 12 months, they're making money. That is our business model, but there is an organic business as well. And how we do that is we cross-sell first. So we have a client portfolio because we have multiple solutions. So we cross-sell to those clients. We have product partners that refer their clients to us. And we have a direct sales team that's out knocking on doors and trying to win us business. So there is a three-tiered approach. Our tech itself, we're consistently expanding it, but we're trying to build this centralized hub of technology and offering pretty much across all of North America. And so we've been heavily in Canada, and that mix is now shifting, where we actually had a very heavy 90-10 mix of US to Canada. Our acquisition at the end of the year actually shifts the mix. We're now more of an 80-20 business between Canadian saturation versus US, because our last acquisition, which formally closed on January 1st, but really was a 2022 acquisition, really put us with a bigger saturation into the US. So that's been the latest shift that we've made around the business itself. But the other part is that we really have a big opportunity for growth through cross-sell, upsell. And we still have to do a better job there organically of really getting in front of our clients. We spend a lot of energy, focus, and money on just normalizing what we buy. But we've been trying to sort of balance that out with some organic cross-sell, upsell. So as you can see, we've done 12 deals so far since I've taken over the business back in 2014. So it's pretty much 1 to 2 every year. And then the one last year was of interest because, yes, we got back to the marketing business. We had just finished the last 2 companies we purchased were point of sale companies, and I'll talk about them in a second. So we bought into those industries, and we had struggles, and even before that, it was payments. So acquisition 9 was a payments company, 10 was a point of sale, 11 was a point of sale. All 3 of those complementary purchases have not been easy for the business. And so for different reasons. So what we decided we want to do is to go back into buying what was much more a repeatable, rinse and repeat model, which was buying a marketing business. So we bought a business called Simply Connect, and it was interesting for us for a number of reasons. One, obviously it played into one of the verticals we're strong in. They primarily only have convenience and gas stations, and it's all throughout the US. They're selling to enterprise clients, not mom and pops, which is our sweet spot. And not so much enterprise, sorry, mid-market clients. So that 3 to 100 location merchant, which is kind of Ackroo's sweet spot. But they also play in brand loyalty, which is a new thing for Ackroo. So instead of just providing traditional loyalty, which is, get your 5% back, they actually have a deal with the tobacco companies where actual consumers that have a rewards program with a gas station, when they go and they buy tobacco, they get an instant discount. Then those tobacco companies send a rebate to the merchant themselves for even more refunds. And then as people opt in, there's even more rebates both for the consumer and the merchant. Those rebates and refunds to the merchants more than pay for our software. So there's this really interesting angle for Ackroo with brand loyalty being also introduced now, where the brands are actually helping fund the technology and generate, attraction for people to go into the actual C-stores and petroleum business themselves. So it's a very exciting new thing for Ackroo to get into brand loyalty, because it's not something we've done before. We've been traditional loyalty in itself. So this was a toe in the water, not just the US market, yes, and good clients in a vertical we know, absolutely. But the exciting thing for us is brand loyalty, an opportunity for some organic growth as we start to see our clients get rebates from providers and tobacco, and in time maybe it's Pepsi and Coke and other large brands. But with that, we then started to see that we could also still follow our same path of paying 2 times revenue. This time was a mix of both cash and equity. And so the goal once again is, how do we normalize this business once again in 12 months? From a financial highlights perspective, we've maintained our 90% retention rate since COVID, but we were a 96% retention company before COVID. So we're trying to work as a business to get back to our pre-pandemic retention rates, which was 95, 96%. Us being down at 90% is a bit of a shift for us, but it still allows us to manage our business effectively, where what we don't want to have is our organic growth is really just offsetting our attrition. So that's where the acquisition growth has really become important for us. We've got very high gross margins in our business. We're at 91%. Obviously, this has to be audited. Our recurring revenue is like 85% of our revenue now. And we've been managing our business to a 20% EBITDA, which creates a healthy business. I talked about revenue CAGR already, but the other things that have added to this that were on the deck before is we really talk a lot about revenue per employee. And with things like inflation happening, where there's all this pressure to increase salaries for staff, it's an important metric for us. So how do we maintain EBITDA? We'll also pay people really well. Well, we look at revenue per employee. So 2 years ago, our revenue per employee was $200,000 per employee. Last year, we finished at 225. Our goal this year is to be at 250. So that allows us to not only generate earnings for the business, but also us to pay our people well. And that's important, so that way, we can also attract good talent and reward our employees, while also having a business that's profitable for our investors, to keep buying more businesses, what have you. We finished our year with about $500,000 of cash in the treasury. In doing so, we got our debt ratio less to 3-to-1 on the year as we close the year. We've been EBITDA positive since 2018. And again, it was our 12th acquisition to date. Here's all of our milestones that we've been throughout the years, from when we started the business in 2012 to when I took over in the summer of 2014, and then the acquisition story that we've had. The most recent thing is that we've been acquisition forever, and then at the end of March will be our first divestiture. And so, I mentioned a little bit earlier about, we've been on the acquisition path, and as we got into complementary business like point of sale, we learned it wasn't as simple as some of our theories were. And knowing that we had a marketing technology business, and then we added on being a payment broker, which was simple because payments just reselling somebody else's technology. But getting to point of sale, there's a whole other tech stack to learn and get your head wrapped around to expand, was hard for us. And we had all these theories about taking that point of sale for golf courses that have restaurants and have a retail shop. We thought, oh, this is great. We'll sell point of sale to our restaurants, and we'll sell point of sale to our retailers. Well, in theory, that's great. But as we got through it and spent lots of time and energy, we couldn't repurpose that technology. And so not being able to kind of expand the tech across other verticals was problematic for us. And then the business itself, golf, didn't grow. So it wasn't a growing asset for us. If anything, there was a decline in the number of clients. We made money as we managed the operations well, and we managed the earnings like we typically do. So we had a very good earnings contribution in the end, but it wasn't a growing asset. And it was a very services first, technology second business. So we decided to get out of it. And we sold it back to an association that wants to be a services first, technology second business. And they're actually renaming themselves GG Golf Technologies. So that's the first of a divestiture that we thought was smart for the business. Take that capital, reinvest into things like Simply Connect was for us, which is back into our vertical market. It's not to say we wouldn't buy POS again in the future, but it has us more interested in maybe reselling POS as opposed to buying them because of the complications that we saw there. But so our inorganic strategy hasn't changed a whole lot, that we're going to continue to acquire every year. We'll acquire 1 or 2. We want to add tech and talent. We want to normalize within 12 months. But we really do see a path that after the first year, how do we have for every $1 of revenue, there's 40% of EBITDA. So we talked about a 20% EBITDA across the total business, but we actually see, some of the acquisitions helping to fund our organic business to keep going, because we do want to have a balanced organic business. We don't want to have just an inorganic business. So we still keep reinvesting in the organic business in little drips and drabs to try to get it growing further as well. Where, we're trying to maintain that, magic number of 40, we're 20% EBITDA and 20% growth. And how do we do that? And it's been primarily through acquisition. If and when we can get the organic growth going a bit greater, that will really make that whole journey a little bit easier. Our business model is pretty simple. We have one-time setup fees for our platforms. Our clients then pick a monthly subscription that go as low as $35 a month to as high as $500 a month, depending on the platform and program that they're using. We get residuals from the payment and POS companies. And we have other one-time revenue. But on average, we're making a little over $100 per location per month. And so that is our, one of the metrics in following our business is, well, are the locations growing and are they growing? And secondly, is the revenue per location growing? So we have eyes on both revenue per location increasing while also the number of locations that we're adding into the business. From a marketing positioning standpoint, we really just came out as a gift card loyalty company in the beginning. Today we advanced, and I mentioned earlier about into payment and POS. So we're a marketing business fundamentally, but we are a broker for payment. And we do have today until the end of the month, both GG Golf and IDMS as these niche point of sale solutions. And, the last time I was on here, I had the future being point of sale. I had Ackroo POS being the future and Ackroo marketing and Ackroo payments being the complementary. We recognize that a few things are happening with Ackroo. One, that path was hard. But the second is that last spring, really almost within a month after this call, Paul, we made a fundamental change at a board level. So we weren't aligned with our board last spring, and we had gone through a couple of years of a troubling relationship around from my vision and their vision. They just weren't aligned. And in doing that alignment, one of the changes was I had to change the board around the business. And so we did that. So we have a whole new set of board of directors that joined us. But as a part of that new board joining us and new investors coming in, that new investor group has got Ackroo committed to one of two things in the next 3 years. The expectation that we either privatize or sell the business. So Ackroo will privatize or sell the business, or at least go through that sales process in the summer of 2025. So we're going to go through that strategic process of evaluating options and strategic options for the business in 2025. Because with that new board, that was their mandate. They wanted to force a liquidity event for them, which I totally get and understand. So we're on a 3-year treadmill. And within that 3-year treadmill is like, how do we get the business maximized and optimized for either privatization, because the public markets haven't been that beneficial for us, or sale. So we're going to go through those strategic options. And so a lot of these decisions, why would you sell GG Golf? It's $1 million of revenue. Well, it's not growing. So I'm going to go sell that and buy stuff that grows. Why would you not focus on point of sale? Well, because it's a longer tailed thing to develop. If we've only have 3 years to really get a great business to privatize or sell, and we go from being the consolidator to the consolidated, which is the vision, we have to simplify the business down. So we're working really hard to simplify our business down as much as possible. So you need to see us continuing to simplify things down for the business and optimizing things like our earnings, improving our operations, putting us in a position that if we are to choose to privatize or sell a business in summer 2025, that the business is in a very simple state to do that. So probably lots of questions on that, but I'll answer all that stuff at the very end. But it's a very big fundamental shift since our last talk, Paul. Like probably the biggest change is that now we're trying to build towards a potential privatization or sale in a few years. But fundamentally today, we still have 3 products: a marketing business, a payments business, and a POS business across 4 verticals. But we're going to keep looking to simplify this down as we work towards that tipping point in the summer of 2025. When we look at our addressable market, it's not small. Our marketing business, there's millions of merchants that are out there. We're just scratching the surface of what we have. And so our payments business, millions there. We just have a small portfolio. And IDMS, the used car dealership market that we have for our niche point of sales, a big market there. So there's a big addressable market for us that we're working through. I showed this slide last year, but here's the updated one from 2022. So this is a snapshot of where Ackroo is today. We have about 2,000 clients, a little over 5,000 locations that we support. And then you can sort of see organically what we added last year versus inorganically. And the interesting story is if you look at it, well, organically and inorganically, we added the same number of locations. So why not just keep putting more money into the organic business? Well, we spent $1 million on sales and marketing, and the organic locations that represents is only about 30 grand a month. Whereas inorganically, we spent $2 million, but we got 100 grand a month of revenue. So we spent twice the money for 3 times the result. And then we got talent, we got tech, we have brand loyalty. So you're getting way bigger bang for your buck through the inorganic model than the organic for us. And the beauty of it, that the inorganic deal was we're cash flowing it. We used the cash that we had in closing the year. We had a line of credit that we had access to kind of cover off any kind of slippage around spend. But then we built an earnout model that we can actually pay it through cash flows. on the back end of the year. So it's being fully cash flowed. There's a bit of shares that were issued to kind of give them some skin in the game, but primarily the whole acquisition was cash flowed, which is great. So here's an example of our merchant portfolio. It kind of shows the small to mid to enterprise. Our sweet spot is the mid-market, I'd say. It's where we bring the biggest value that, when we bought Simply Connect, their investor deck was all around 2 to 100 locations. That is our sweet spot, even though we have larger brands and locations that extend beyond that. And we do have lots of small single location businesses that we provide services for, but we spend a lot of our mental and development energy on that mid-market merchant. How we do it is a lot through partnership. So this ecosystem is very fragmented, lots of players. So you have to work with them, integrate with them, partner with them, but it's also a very, consolidated industry itself. Why we had to get into payment point of sales, because a lot of these companies are combining and consolidating and buying each other, right? And so, there's a big partner ecosystem. And then lots of competition, both competitive and complementary competition that kind of play in each other's segments. And I kind of show ourselves as being, in the gift loyalty side of it, but we pay in payment now, and we play in point of sale as well as with a number of these providers. So everyone's kind of playing in different positions from a niche perspective, but there's lots of players out there. So from an investor standpoint, we've still stayed true to our focus of being a consolidator first and supporting all merchant types. We didn't pick one vertical. We didn't do just retail. We didn't do just hospitality. We diversified. And we did it through multiple offerings. We didn't do just loyalty. We did gift card. We did loyalty. Now we're doing payment. So there's industry diversification and vertical diversification, which makes it harder and more complex, but it also gives us a lot of moat around what we do. So when things change in the industry, where one vertical suffers, the other one covers off, and so on and so forth. So that breadth of offering has really played well for us. Our platform being very self-serve means that, from a services standpoint, we're not so dependent on staff as much, because we have this technology that's the asset. It's not, clients aren't coming here for our people. They're not coming here for me. They're coming here for our technology. So that's what technology needs to be a first thing. We've tried to make it as affordable as possible. We've done it through a direct channel and an actual partner channel, and then the geographies that we've had. But I think as an investor, what's interesting is that we're touching on all the things we think are smart. We've figured out how to normalize quickly. We've made sure we're profitable. We're not losing money at Ackroo. We generate cash, and we know how to acquire and normalize. There's a lot of businesses out there that are struggling right now because they're not profitable. So people are knocking on our doors. I got a call last weekend about, again, people up for sale because they're not in a profitable state. The company we bought, they were losing money. So we were in a position where we could take them from losses to earnings. So the inorganic growth story is going to keep on moving for us, which is great. And that'll allow us to kind of continue our revenue growth as well as a business. But when I think about peer multiples and the other economics of our business, is that even our CAC, our cost to acquire relative to our lifetime value, the economics are still good. And our valuation, I know it's not Ackroo isn't alone, Paul, it's the whole industry. From a multiple standpoint, we just bought more than we're trading at, right? We just bought greater than now we bought it out of cash flow, which helped. It's not like we did it out of shares, so that's what made it accretive. But fundamentally, we're a deal. Like our stock we would be buying if we didn't have debt on the books, right? It'd be one of the first things we'd be looking at is our own stock from a valuation standpoint. So that's how we look at the opportunity. From a share structure standpoint, like Trevor mentioned, we have 121 million shares issued. We do have some options that are outstanding, some warrants that'll expire later this year, and there's the strike prices for you. And as of the early March, we were at a $9.7 million market cap. And then that's the ownership split. So it's very saturated across management, board of directors, and some selective insiders. So not a huge float. So it means the stock can really move up or down in a material way when there isn't a huge float that's out there. From an executive team standpoint, there really is just myself at the C level right now. We had a CFO that left the business after 6 years. We hired another one last year. And one of the other changes that happened after this last call is that we separated from the last CFO. It wasn't a good fit for the business. He came in as a part-time CFO, and that wasn't great for Ackroo. We needed somebody who was more full-time in the business, a partner with me. So the part-time CFO wasn't a good fit for Ackroo. So we've continued to look for that, but we're also looking for a CTO, CPO. So full-time CFO, COO, full-time CTO, CPO in the business. So we're actively out recruiting and looking for those people to join the business in that respect, with the premise in mind that these people are coming in really just to help us privatize or sell in the next 3 years. So it's made it even trickier from a recruitment standpoint, because now they have to have the appetite not to come in here for the next 20 years of their career. Maybe it's just to help put a bow on the business and move on. So it's a different type of recruitment. And then we have some VPs in the business across product and finance and admin, and we're adding a few others in the coming months. There's our board of directors, which is myself, our lawyer, Sam Cole, our actual old auditor, and Jeremy he was working at Grant Thornton before, which is our old audit firm. And then we brought in some new board members, both in Brad French and John Clare, who are successful entrepreneurs themselves and have sold software companies and are part of them and had seen big success there in commercializing them. And ironically, their success came from monetizing customers, not just their clients. So similar like the brand loyalty I was mentioning with monetizing tobacco for Simply Connect, they did so in monetizing customers through the funeral industry is where they've had a lot of big success. So they have experience in this whole monetization of end customer. So some great expertise there. And then Philippe has joined us, who you guys are probably familiar with as well for the Microcap Club, as a representative on behalf of Rievemont. Rievemont is now the largest shareholder of Ackroo, and as a representative for them, he represents them on our board to provide that capital markets insight and research as well. So that's our board. And then lastly, I'll just share our priorities for the year. For us, it's to continue cash and EBITDA management. Cash is king for every business and every person right now. So we're going to keep trying to work at, that quarter over quarter EBITDA growth. And how do we maintain that 20% plus EBITDA number? We're going to keep paying down debt this year. We paid off $1 million of debt last year. We're going to keep paying it down. We're going to get the ratio to less than 2-to-1 this year. And we think it's really realistic. We're going to increase that revenue per employee, like I talked about before. We buy lots of companies, so we have technical debt here. So we're going to chew down some of that technical debt that we've got through acquisitions. We are going to still advance our marketing technology and our POS technologies, and we want to simplify it. Whether it's divesting of those assets or simplifying those assets, there's more work to be done with some of the assets that we've acquired over the years. So you'll see more of that information in the future. The payments business is a good opportunity for us where it's easy. Like there's no tech costs. You're just a sales agent. You're just a broker. It's like being a mortgage broker. It's just commissions. So we definitely want to keep working at that. We want to improve our operations. We want to make it easier here, even though we've talked about privatization or sale, but making it really easy to map your way within Ackroo and outside Ackroo is important for us. We want to grow the recurring revenue, but obviously increase the share price. We saw this massive share price decline, not just with us, and I know it's our industry, but how do we bring greater value per share to our shareholders? How do we do smart things for our business that increase the value of our company? And so we're trying to think long and hard about how do we make sure that we get this really big return? So whether it's privatization or sale in 3 years, we get a very significant premium to market, not a little one. And we only do that by being aware of the shareholder and the share value. We can't just forget about it and think about the business. We are thinking about both as much as we can. And that's it.
Perfect. Steve, yeah. Great job. Great job. I can always tell how good you do because you've answered almost all the questions I've got here. So, but I've got a few left over. And before I jump in, I want to remind everybody, if you've got a question you want me to ask Steve, use the chat function and we will make sure to get that question answered. Steve, obviously a lot of changes over the last year, but I want to talk a little bit about the board. And yes, it's something that we talk about a lot lately. What do you want to see from your board, and like how active do you want to see a board? You're a small company, not a lot of people are happy to be board members, but in a case like yours, what do you want to see your board members do for you?
Yeah, and I think a board has a few roles, right? And for me, governance was the first, right? So you kind of want to make sure I speak as if we are a train, help lay some tracks, right? Let the train run, but we need some tracks around us to make sure we don't fall off and get ourselves into any kind of trouble. So they're there for making sure that, from a general standpoint, they're the tracks that our train can run on. But from a functional perspective, we have priorities, right? So yes, I've got a lawyer that makes sure that we've got traditional governance. And yes, I've got an accountant to make sure our finances are in order and that we're really keeping acutely aware of the numbers. So that's important. But there's other functional people on this board that we're asking to do different things. We talk about the mandate of privatization or sale. Well, how do we do that? Well, we've got board members that have been through that. They've taken a small business that's smaller than Ackroo and built them up and exited in a material way. And so we're asking their expertise to introduce us to their networks from a private equity standpoint and their networks into industry. We're also asking them to show us some of the path that they've done organically, open up some doors for us, right? Introduce us to some opportunities. Everybody on our board knows somebody in the merchant community, so they should be able to open up doors for us as a business, but really helping to guide us to make the business optimized and attractive for sale. So, and while we're doing that, I look at each individual as a different role, right? And even Philippe at the end, he has a link into the capital markets. Well, I'm asking him, you help us with awareness. You let us know who needs to know about our business and when, and you help guide us into that investor awareness piece and let us know where we're dropping the ball there. While I'm using the others to have more operational value, how do we get organic growth better than what it is? How do we simplify our operations, guys? What did you do to package up your business for success? What VCs did you work with? What was your financial structure? So it's a lot of like that kind of leadership and guidance that I'm hoping to get out of the group. And that's what I'm trying to drive them towards. Does that make sense?
Yeah, absolutely. Absolutely. It's exactly what we want to see from an active board. You want to see people who have a skill set that you can work with.
And they have skin in the game. Like our board members, they're the ones that bought out the old shareholders. So they've written significant checks to exit the old board members themselves. So, they put in collectively, 7 figures, these, collectively grouped. It wasn't small checks that went in to have that voice. So they have a vested interest as well. It's not just because they like me, they actually have a vested interest with their own pocketbooks. And they came in at 12 cents a share was the strike price for all of these guys back then. So that's ironically close to my cost base average too, personally, even though I've been buying lately to try to get my cost base down. Really, I'm around 12 myself. So yeah.
No, that's a really important point. I think there's far too many boards on microcaps that don't have a vested interest. They're kind of there either for options or as a favor to the CEO.
Yeah.
You mentioned you're prepping this for an exit, but who buys a business like yours?
So there's a number of potentials. So obviously there's people in our direct industry that are bigger. So there are players out there that do exactly what we do, that are bigger than we are, that would have an appetite for, like we are consolidating the smaller. As we get to critical mass, there's an appetite to consolidate us. There's also complementary companies in our ecosystem that are already actively in conversation that the value in bolting on Ackroo as a complementary offering to their business in the payment and point of sale world is pretty attractive. But to get there, you kind of want to move the needle. And we've been flat out told $10 million of revenue, $2 million of EBITDA is the minimum that we need to be at to really move the needle for some of these companies that have an interest. So we've been on a path to double the business. How do we go from 6 to 12 million of revenue? And, from 1 to 2 to $3 million of EBITDA. And so it's these complementary companies that would be even more interested in paying even a larger premium because it's, there's lots of cross-sell, upsell. But like us, there's bigger versions of us out there that would also have an appetite.
Mm-hmm. And then just operationally or otherwise, what do you feel is your biggest challenge in this business? What sort of keeps you up at night?
There's multiple things that I lose sleep over. One of them is people. I find people is a hard thing. And, getting, especially now that we've got a mandate, like we have a North Star that we're trying to work towards, but getting all the bums in the seats at the right time in their careers is important. I've been talking to people about a rocket ship opportunity here where I want you to come in. This is a springboard for you onto the next thing for everybody. So it's getting the right buy-in, the right bums in the right seats that are engaged and interested and that want to see through the vision as well, that it's not just a job, it's them trying to get through the finish line with us. And that's hard, right? Because for some people, they just want to, do good work and move on. But we kind of need these passionate people that want to see us through this exit that's in front of us in a few years, right? So people is a hard thing. I lose a lot of sleep over it. Do we get the people right? Are we rewarding them right? Are we developing them correctly? So that's the first. The second is speed. I feel like everything moves too slow. I think everything moves too slow. It'll go back to your operational question in a second. And so how do we move quicker? How do we get deals done faster? How do we close faster? How do we buy faster? How do we do everything quicker? Everything's just too slow. And so operationally, we got to get more efficient because everything feels really slow. So I stress over, why are these parts of my business too slow? How could we make things more efficient for us and our clients? How do we, make things more efficient for our business? So I stress over efficiency. I stress over the speed in which we do things, and I stress over the people around the business are the biggest things that I lose sleep over at night. So those are my 3.
Gotcha. No, we hear the same from a lot of CEOs right now. Your balance sheet, you said you got about $500,000 in cash right now. Obviously, you're still trying to acquire. You're trying to double your business. Do you guys have what you need to get out there and keep acquiring right now? Do you think you might have to go to the market, or what are your options to either finance or to keep acquiring?
Yeah, so we had $500,000 in the balance sheet at the end of the year. When we bought Simply Connect, it was $1 million. So we, had some ARAP management to get that deal closed. We actually went into the negative $500,000. We're closing on the divestiture of GG Golf of 1.6 million. So we'll be back up a little over $1 million of cash flow from there. So we'll have about $1 million of cash sitting in the treasury when the dust settles after the divestiture happens with the business. And then, it doesn't give us a ton of capital with regards to going out and buying, but there are more levers we have to pull, whether it's structuring deals, because the deal with Simply Connect was half cash and half earnout, so to speak, because of the timing of how it was structured. There's other deals like that are available today, creative deals that we can structure that allow us to kind of use the capital that we have and that we're growing to allow us to keep doing deals. We do not have a plan to do any financing between now and the next 2.5 years. That isn't at a discussion at this stage at all. The goal is over the next 2.5 years, how do we, take this current business and our current share structure? And if we use shares, it's with an acquisition, right? We make it appealing to acquire with a bit of shares and a bit of earnout or a bit of our cash and whatever. It's not to go out and to do a traditional raise in the marketplace at this stage. When we were trading at a very good premium, it was a discussion, and we didn't do it back then. I think it was an error as a business that we probably should have raised when our share price was much higher, and we, at the time, the collective unit chose not to do that. But unless the shares start trading at a significant premium over what we buy, we wouldn't do a financing. Right now, especially when you're trading at such a low multiple to what we buy, it doesn't make business sense for us to do that at this stage. So if in a year from now we talk again, Paul, and we're trading at $1, I may have a different opinion.
Right.
But as of today, there isn't a plan for that.
Yeah. So I saw that, in some cases you did issue shares for the acquisitions. I mean,
Yeah.
I can see a value in doing that, and I can see, a reason not to do that because of the discount in your shares. But what do you prefer to see? Because there's you kind of want that vested piece, especially while you guys are integrating and transitioning. Do you not?
Yeah, it's tricky. Like if you saw our early acquisitions, it was all stock because that's all we had, right? We were burning cash, didn't have cash. And then, the last 5 deals have been all cash, right? Or the last 4 deals. And then this last one, the problem with all cash deals is then there is no vested interest to make sure that there wasn't extra hidden attrition. And there was no surprises. They're not really that vested to make sure that like we can grow right away. So the deal is done. They don't care what it looks like afterwards. They're paid, they're out. So there is this better hybrid where there's a bit of skin in the game, where there's a bit of stock, where care a little bit. There's not tons of liquidity in that stock, so they can't just dump it afterwards anyhow. But even in this case, the deemed value of shares was at 12 cents a share. So the shares they took were at 12 cents as well. So the deal was negotiated at 12 cents a share, even though we were trading at 7 or 8 at the time. They even saw the intrinsic value as much greater than even 12 cents. So the deal was done at a premium to market from a share price perspective, which we thought was good. But I like a little bit of shares in the deals personally, but as little as possible, right? That 20, maybe 30% is probably as high as you'd want to go from a mix. And this was exactly in the middle of 25, right? And so that's a nice mix where there's a bit of equity. So they care to help make sure that you not only integrate, but optimize. Whereas otherwise it's on us to integrate and optimize.
Gotcha.
Yeah.
Listen, we're almost at the last of my questions here, but one more to do with just the capital markets. I mean, you're a nano cap. We love nano caps. That's the market we play in.
Yeah.
So we pay attention. But what's it like out there trying to get attention as a nano cap in the Canadian sort of space right now?
I find it really difficult in that attention both even just from trying to have investor conversations. There isn't a big appetite. There was a time when I had people constantly reaching in, analysts and just trying to understand what our business is doing. Just retail investors would contact me looking for a call. That's not happening right now. So I'm not getting retail investors emailing me, asking me questions. I'm not getting the institutions reaching out to me looking for a call. So it's very quiet, to be honest, around that. And that's okay for the short term because right now our focus has been on the business. But I'm eager to see that change. I'm eager to see some people knock on our doors to see oh, wow, these businesses that have gone through these high inflation, focus on cash times, companies like us that are mapping through that, maybe we should be talking to them. So we're not having a lot of calls, Paul, to talk about that yet. But, my brother-in-law, he's, an investment advisor himself. And I ask him all the time, I'm like, are your clients dumping money? He's like, not yet, but it might be coming. right? So people aren't getting off the wallets just yet, but because there's this whole apprehension. But like anything, it's probably a snowball game. Once it starts, the snowball will roll.
Yeah, that's usually the way it works.
Yeah.
Listen, Steve, we've sort of come to the end here.
Yeah.
You know, we always give you an opportunity to sort of leave us all with a key takeaway. What would be the key message you want to make sure everybody walks away with today?
I think for us is that we're on a very clear strategic path here. There isn't, you know, I felt like for a number of years, it was, you know, we were on this treadmill. What's the finish line? What's the end goal here? Like, what are we doing here? So I think what's interesting and exciting at the same time, and even scary for me personally, is what's next for Steve, is like, there's a finish line we're running to. And because of that, it's actually created a much better discipline than we've ever had, a much clearer focus than we've ever had around our business. And I think we're gonna have a much bigger outcome because of it. So I think we've gotten smarter as a business. I told the whole leadership team at Ackroo, last year was hard, but sure as heck, we got smarter last year. So I feel like we learned a lot last year, and now we're getting a smarter and smarter business. So we're running a very definitive outcome for the business and for our shareholders, which should be really exciting for people around the business. That we're gonna make sure that we create a great outcome for everyone associated with this thing in the next few years. And so, you know, keep your eyes on what we're doing. Reach out and ask me questions if you have it, and provide any guidance that you want to extend. But I think a good outcome's coming for Ackroo and our collective shareholders. So exciting times are in front of us for sure.
Fantastic. Well, great. Listen, we've been speaking with CEO Steve Levely of Ackroo. Symbol again is AKR on the Venture Exchange. Steve, always great to catch up, and look forward to catching up with you again soon.
Awesome. Great talking to you, Paul. Take care. Talk to you soon.
Bye for now.
Bye-bye.